about the state of liquidity in the country. They are concerned that it is continuing. No signs that there is improvement. It's so much so that the banks have now, one after another, been announcing interest rates increase. And they are doing that without taking, this time, advice or cue from the central bank. The question is, has the central bank, being the Bank of Botswana, left consumers, that's individuals or homesteads, business community, basically left them to their own devices, so much so that commercial banks can do as they wish to maximize profits? But is this really a legitimate concern? There's one who's going to help us understand this question further. His name is Stanfford Dube. He's an expert in financial matters. Mr. Dube, welcome to the Atlas, as usual.
Thank you very much, and thanks for having me.
Let's begin right away. Is it justified, the concerns by the consumers, that they've been left to their own devices, to whatever the commercial banks would like to do to maximize profits?
I think we need to unpack it, particularly to explain the concept, the monetary transmission mechanism, which is at the upper end has the Bank of Botswana, and has the objective of actually controlling the economic activity on one end, and also particularly to speak to the inflation. So along this monetary transmission mechanism, there are a number of rates that we can talk about, one of which is the repo rate. Then you have also the monetary policy rate, and then you also have the prime lending rate, and then you have other interest rates that are falling within the range. The question is, which ones of these is the Bank of Botswana controlling? And what possibly is the impact to the two variables I spoke about, which is the economic activity, GDP, and also the inflation on one end. The question is, why have some banks possibly adjusted their prime lending rate? As I said at the beginning, repo rate, then we have also the prime lending rate and the monetary policy rate. Where we are now, this rate has not been changed, but the prime lending rate has been adjusted slightly with around about 0.75%, I think, with some other banks going up to 1.15%. The question is, why is that so? I think as we go along, we'll keep on explaining what is the reason.
So is it your position then that no, there shouldn't be any concern within the community of finance product consumers? I mean, businesses, and you could call it retail market.
I think around 2023, April, the Bank of Botswana did announce that they are not going to be involved in the adjustment of the prime lending rate. So what is the question that we possibly have is, what is the prime lending rate? The prime lending rate is generally the base in which other loan facilities are charged from. Before
you go with the explanation,
yes.
Is what the Bank of Botswana did, is it common within the community of central banks? And if it is common, how frequent does it happen in different countries, including Botswana?
I think the whole idea is to deregulate the market and try and allow the market to run itself. It doesn't necessarily mean that the Bank of Botswana has completely neglected the whole system. There are still an oversight body that is going to still regulate the behavior. But at this particular point, I think the adjustment of the prime lending rate are justified because you have a situation where the government has mopped out a lot of liquidity. And because of that, remember that the interest rate particularly has two implications. The first one being that it attracts investment, it attracts saving. When you increase your interest rate, you are attracting saving. So that you can try and improve on your liquidity. On the other hand, you are discouraging borrowing, which is what many people are concerned about. But those who are investing, they're actually happy about what has just transpired. It's quite a normal thing, because when those who have surplus money indicate that they are not happy with the current level of interest rate, they will not save, they will not invest. So to encourage them to do so, you rather just raise slightly your interest rate so that you can attract a bit of some saving and interest, saving and investment from the general public. Yeah.
Okay, let's look at what happens then. Yeah. Let's say the Bank of Botswana now allows, you could say, commercial banks
yes.
To compete.
Yes.
For the market to determine whether they are going to go to Bank A, judging on the cost of borrowing
yes.
as it is. And then someone wants to get a loan today. You get a loan today because you've done a shopping around
yes.
and you stuck to this bank.
Yes.
And the next thing, this bank decides that it is now moving to the next level with interest. Isn't that taking advantage of consumers to maximize profits?
I think we need to unpack that prime lending rate issue that I spoke
Let's
about.
Let's start there then.
There are quite a number of other factors that actually contribute towards the determining the level of the prime lending rate. Of course, first of all would be the cost. The cost of borrowing will determine the prime lending rate. We also have other factors like the risk appetite of the bank. We also have the issues that market conditions. I mean, the perspective and the view of market conditions is quite different from bank to bank and from individual to individual. So when the Bank of Botswana says, let's allow these banks to actually determine their prime lending rate, it's just about how they feel the pressure from their cost of borrowing, the pressure from the markets, and many other factors that contributed prime lending rate. So in this particular case, you would see that there is pressure from the market that has pushed some banks to actually react that way. In actual fact, not all banks have reacted that way. Some banks have still maintained their prime lending rates. Some have adjusted. Some already have higher prime lending rates. But the whole thing is just about a reaction from the market. So you can generally say, no, they're justified.
Okay. Now, I also want us to just look into, say, the ultimate goal.
Yes.
The ultimate goal. What is the ultimate? Is it to control or to address the problem of liquidity at the moment, what the Bank of Botswana did?
Yes, the whole objective is to address the problem of liquidity. Remember that...
And are we winning? Is it showing signs of... I know that it was done 2 years ago, 2023, but the banks only started to effect that liberty that they were given. One will be interested in seeing, are there signs, or is it too early to say that we can tell whether it is effective or not?
It's too early, I think, to say so, but we can recall again that 2020, there was an adjustment again on the reserve ratio. The whole objective was to try and release the buffers that were actually there. It had a short-time effect, improved liquidity for a short time, and went on to try and liberalize the prime lending rate and try and allow these particular banks to charge their own prime lending rate, which, of course, I think with the stability in the markets and being able to deal with this and that and liquidity and so forth, they were able to achieve the objective. But what we have now is the government is actually battling with the budget deficit, and it has to fund its deficit. I think you are aware that we still have a slump in the diamond market. We haven't sold, and because of that, the government is in need of money. And unfortunately, or fortunately, I would say, the government seems to have more appetite in domestic markets, and by so doing, they are mopping out the excess liquidity that is there, is being taken by government. So for banks to respond according to that, they have to try and find a way of trying to access more liquidity, and they are doing so by adjusting those prime lending rates.
Okay. So what is happening let's look at the working class? All right.
Yes.
The government is mopping out excess liquidity. You could say that, banks are now tightening, given the problems in the economy. Is it the time when you and I can apply for a bank loan, and one of us doesn't get it, but not because their profile says they don't deserve it, but because there's limited amounts of money to be loaned to consumers?
There are two things that have always happened, but we probably had ignored them. When we apply for loans, we are told that there's flexible interest and there's also fixed interest. In many cases where there's flexible interest, it simply means that if there are adjustments, they will affect you either negative or positive, depending on the direction of the adjustment. If we are fixed, it means that the direction of the adjustment does not have any effect on the loan. So it's just about what type of a loan facility have you applied for. If you've applied for a flexible interest loan, then it means you will be affected by the increase. But when there is a decrease also, it will affect you. So in other words, your repayments can be cheaper or more expensive depending on the direction of the changes. But that has always been there. It's just that the economy has been stable over time, and we have always thought that the interest rates or the interest paid is always fixed at a particular level. It only applies to those who have fixed interest. They can do so. So if you want to apply, and the situation is in this point, it can affect you positively or negatively. So it's just about a person's risk appetite, whatever level that they can appreciate, they can be able to apply for a loan from that perspective.
So make it very categorically clear as a finance expert,
Yes.
Mr. Dube, this concerns in the market by finance consumers or financial products consumers.
Yes.
When we hear from government, they will say that we are in tough times, but everything else is intact. In fact, the fundamentals of the economy are intact.
Yes.
So much so that they shouldn't be too worried about this. As a financial expert, is that your position also? I'm hearing you like you're saying, look, there is no need to panic. This is normal.
Well,
this meaning what the bank has done, the banks are doing following the decision by the Bank of Botswana, number one, to free the reserve
Yes.
that they held
Yes.
for the banks,
Yes.
which is it was understood to be addressing the issue of liquidity also.
Yes.
And now the banks are also enjoying the 2023 the decision that the banks took by that time. All these things, to some people, suggest that there's a problem. But the way you put it now is like, but there isn't actually a problem that you should be worried, number one, that you will not get a loan if you qualify as usual.
Well, we have explained that we have a structural problem. I mean, from the diversification point
Yes.
of view, that has always
Yes.
been explained.
Yes.
What we would possibly be worried about is what will happen hereafter. Like we said, we're still putting our hopes that if we manage to sell our diamonds and slowly diversify our economy, we may stabilize. I mean, such situations have happened before, and we've managed to come out of them. But of course, what we are not sure of is whether we'll come out of this one or not, and what would be the consequences of such an action. That's possibly what we can say for now. Because if you look at some fundamentals, like our inflation is still all right. I think we're still concerned. We are more concerned about our GDP currently because it's projected to be negative, and that's understandable considering that our economy is hinging more on the diamond revenue. So you would understand that that could be possible from that regard. But there are solutions, I mean, that could be considered possible to try and deal with the problem in case that the problem continues in that way.
I wanted to get you to talk about the what else can happen, what else can the central bank do to improve liquidity problems.
Yeah. Okay, so when it comes to the issues around liquidity, there are quite a number of things that we can do. If you look at the repo rate that I spoke about at the beginning, it's normally used for short-term loans between the central bank and the commercial banks. So normally the biggest challenge that you have there is that it's so short-term, and also the second thing is that normally there's a requirement of collateral. So what the central bank could possibly do is to probably adjust the period so that it can be a longer period, and also to deal with the issues of collateral, probably ease on the collateral aspect, so that the banks would then require more funds from the central bank, which is the Bank of Botswana, rather than increasing their interest rates on the other end. So I think if they could do that as the first option, that could actually be a better way. And the other thing is to try and create the interest rate corridor, where you've got the upper level and the lower level of interest, so that the banks can be allowed to flex in between that particular corridor. If they do that, that could actually regulate the behavior of banks in a way. Otherwise, those who want to go higher, they can go higher to a particular point, and those that want to go lower, they can go lower to a particular point. That still works out as a solution that could actually work out. But the other thing, obviously, is engagement. I mean, it's time that the Bank of Botswana probably sit down with the commercial banks and have engagement with them, and they explain and express their concerns and possibly how best they can be resolved together.
Okay. Just in a few seconds, I want to learn to get it from you. Do you think more banks are going to announce increases, interest rates?
Possibly, yes.
Okay. Do you think those that have already announced may go a bit up?
Not really. I think it's a question of, remember, they are twofold. When the interest rates go up, some people in the markets are quite happy because there is a higher return. So it's a question of how this thing is benefiting the market. There are certain individuals, or there are certain players, I would say, who are actually benefiting from high interest rates, particularly in the markets. Unfortunately for the consumers, particularly for us who want to borrow, we may be crying in that regard. But those making investments are quite happy with higher interest. So there's a certain level that would be acceptable, but the other, to a certain extent, I think there will be a limit in terms of how far they could go.
So those who are crying are those who are borrowing for consumption, those who are borrowing for production, happy? All of them
not
are
really. Those who are lending,
who...
actually the ones who are benefiting because they've got a return, a higher return for their investment.
Right.
But for those that are borrowing, like me and you, possibly we have a challenge in that regard. Yeah.
All right. That's Stanfford Dube, a financial expert, helping us understand the challenges that the nation is experiencing, which are hinged on structural, the economic structure itself, the financial market structure itself.
Yes.
And his position is that not everybody is crying, actually. Those who are rushing to the banks to deposit are smiling because they know that this time is a good one to make money out of good interest rates.